their buy list ready, the market starts recovering. Except Nifty Bank, bulk of the market has actually recovered smartly. Shreyas Devalkar is now joining us to talk more about markets. Shreyas, afternoon. Thank you so much for your time. Let's start by understanding the impact of this massive liquidity. 22,000 crore from the FMs, you and your friends in the mutual fund industry. Then there is, EPFO money coming in, insurance money. What are we talking about? 40,000 crore every month liquidity coming in?
Yeah, so it's not us only. It is obviously our investors who has chosen this as asset class to increase in their allocation to their asset classes. That process is on since last multiple years. So it's very difficult to point out what is the right number here because I recollect few years ago we used to talk about 10,000 crore and then 15 and 20, so it's going on. In these multiple factors which has affected definitely is the existing exposure to the equity, and equity as a asset class has resulted in the good returns for last multiple years. What we have observed is generally the flows are also to do with the returns in last few years. That definitely affects the flows. So if you go back to 2020s, then the flows were not much because the returns didn't look as great at that point in time, while currently the returns look really great, and especially when it comes to mid and small cap category. So in this category, since the returns are really good, we are observing multi-cap category getting good flows compared to the large cap, which used to be the earlier case. Even large cap categories also started getting returns. So yes, this is widespread and increasing as of now.
Market shares, in your view, does provide the best risk reward, the quality of earnings versus the love it is getting of the market right now. Some parts are, overloved right now, even at the cost of becoming expensive in valuation. But which parts look attractive to you?
See, this dichotomy has been there in the market since long. It is not now. Market single-mindedly chases the relative earning growth, irrespective of valuation, till the time it lasts. It's only about when and whether that relative earning growth shifts from one pocket to other pocket. That becomes and that's where the earning growth part, which you mentioned, becomes critical. The critical part here is the relative earning growth from where to where it is shifting, and once it is there in a particular pocket, generally we have observed that the valuation excesses don't go away till the time the relative earning growth shifts to the another part. So the classic case in point is, again, if you go back few years ago, the relative earning growth used to be in the few stocks. Market was totally into it, and those stocks were super expensive. Today, the relative earning growth is in the capex, power, defense, etc. And then you are seeing this pocket being super expensive. At the same time, the relative earning growth is not there in FMCGs. Even a pocket of banks also are not showing the relative earning growth as superior as some other sectors. So as of now, the way market, I would say that here in this time also, market is not behaving anything different. It is behaving the same manner that it is chasing the relative earning growth irrespective of valuations.
What are your thoughts on power and capital good ancillary? Are those becoming kind of overvalued, or they continue to be fairly valued even after the run up because it is compensated with earnings growth?
So as far as power sector is concerned, this process or this segment has emerged as a key multi-decadal story, not only in India, worldwide. And there are multiple, I think this is already over research by now, that how the demand for power is growing because of the clean energy to urbanization and so on and so forth. So this power growth is going to be the assets and infrastructure which was built in developed countries, which was long time back, need to be refurbished. Assets need to be created to shift to the renewable energy. And in India, back home, the power growth, demand growth is closer to double digit. digit. So all these indicators are pointing to the fact that yes, power is going to be a multi-decadal story as far as growth is concerned. Coming back to valuation, again, as always, what happens is whenever there is this rush to any particular sector which is showing fast growth, the valuations, as it is always said that you should, when there is a gold rush, you should buy the companies who are selling shovels. And here also same thing, the capital goods companies valuations you will always find, and it has always already gone up. Considering these facts, because in case of capital good companies, normally the return ratios, the margins, as well as its prospects always look superior on paper, and that's where there the valuations are high. At the same time, asset owners, because here you carry the balance sheet risk, you carry execution risk, etc., and that's where asset owner valuations are relatively cheaper compared to the capital goods company. And the same pattern you have observed here, that that in the value chain of power, the capital good companies are expensive, while the asset owners are not so much.
Have you started buying into chemical shares or not yet?
See, chemical as a sector, as I would call it out now, it is the sector same as what pharmaceutical 10 years ago. It is fully discovered sector now. So there is unlikely that when one may say that it is going to be a discovery phase is behind. So it is going to be very, very stock specific, the way it used to be, or it has been in pharmaceutical for last 10 years. It used to be very stock selective, and the same case you will observe in chemical, because chemical as a sector, barring few chemicals, so there is a commodity, there is specialty. It is not homogeneous the way it appears. The way pharmaceutical is also not. It is not homogeneous sector. So IT is a homogeneous sector because there is everything goes on in tandem. In chemical, it is not the case, and that's where you will see the differentiation coming out in the stock returns, and that's where investors need to be really selective in this space, because the valuation even after correction are not cheap. Because if the valuations are really cheap at that time, probably this entire sector move in tandem, but that is not the case now.
What about consumption? Which ends of consumption? Typical FMCG companies, or some rural consumption players, some value retailers. What exactly in consumption looks completely bombed out to you and case for relook now?
See, sure. When I started my comment on this relative earning growth and the market's frenzy towards that, it has always been the case, and it is the case even now. So you see the consumption, and just you to bifurcate in two parts. One is the upper part of K and the lower part of K, and you will notice that the companies which are catering to upper part of K, which may be airline, hotels, and real estate, to even SUVs manufacturer. Here, everywhere, the earning growth is there and the valuations are at the higher end. While the word you used is where the valuations are bombed out or not there, it is where the growth is not there, and the growth is not there definitely in the FMCG kind of companies, and that's how that is the fact of the matter here. Here one need to really get into the further details that whether market is shifting to really value category. When I'm saying value, not by means of stock valuations, it is more to do with the buyer's preference to buy value that is being observed, especially in the FMCG category, where more D2C, more small, the local brands, etc., are coming up. So considering all these parameters, whether it is right to attribute everything to the lower part of K or for this lower growth in some of this segment. In that context, I would be again selective in those companies which have not gone up in the FMCG sector, but one need to be selective to accommodate this fact that yes, there is a shift towards or shift from the established FMCG to not so established FMCG companies.
Right, Shreyas, thank you very much for your time. Good to have you live on the show, and look forward to interacting more with you from your end. Thank you. Yeah.
If you like this video, then like, share and subscribe to ET Now.